Hi everyone, this is Jason Burak of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I like to have him on every 3 or 4 months to talk about the oil and energy markets. He has 25 years of experience working in the oil and gas industry. He writes articles for oilprice.com and Forbes. He has 2 paid oil investing newsletters with Investing Daily, and in my opinion, he's one of the top oil and energy analysts in the world. Robert Rapier, thank you for joining me.
Thanks for having me back, Jason.
Now, Robert, I want to get your opinion on the price action in oil. It seems to be oil is stuck in a trading range, kind of a downward trading range. Do you think oil is in a bear market?
Yeah, oil has been in a bear market for 3 of the past 4 years. I mean, starting in 2014, when high inventories started to cause oil prices to break below $100, we had a bear market in 2014, 2015. Bounced back in 2016. Oil was the best performing, or energy was the best performing S&P 500 sector, and then this year we're back in the toilet again. So yeah, it's been a tough sled for oil investors the last 4 years.
Yeah, because I'm looking at WTI prices now. We're at $47.70 on oilprice.com. Brent crude's at $52.21. I mean, these are not prices where the majority of the oil industry can make free cash flow, can reinvest their profits into high CAPEX projects. I don't see that. And yet, you know, it seems that a lot of, whether it's the OPEC producers like Libya, Nigeria, Iran, Iraq, they all want to increase oil production. And there's still good increases in U.S. shale oil production, especially from the Permian.
That's true, but it's slowing down. The production gains that started last about September, October, we went up about 600,000 or yeah. So since last October, when oil production started to rise back in the Permian, it rose very swiftly for about 6 or 8 months, but the last 3 or 4 months now have significantly slowed down. We increased, I think, 600,000 or 800,000 barrels in maybe the first 6 months, and only a couple 100,000 barrels since then.
Do you think that's because all the sweet spots are drilled, or is there other reasons for that?
Yeah, I think they were anticipating higher oil prices than what we've got. So I think when OPEC started making their cuts, I think people anticipated that oil prices would get on up to $60. And once it looked like that wasn't going to happen, the rig count started to decline and the oil production gains started to slow down.
The other thing I noticed, I interviewed Art Berman a couple weeks ago, and he said that he expected a lot of shale producers that their costs were going to start to rise because a lot of the oil service companies had offered a big discount to get more drilling going because they needed the cash flow. So the Schlumbergers, the Halliburtons, they had offered big discounts, and now that they have, you know, their order book filled again, they're going to start to raise prices 15-20%. Is that what you also see?
Yes, that's correct. I've seen that already. It's happening. I forget, one of the oil companies said the other day that their costs were going to go up $3 or $4 a barrel for that very reason. So there's inflation in the oil field services sector.
I want to ask about the costs of the shale producers. Now, I thought initially when shale was starting to boom like crazy after the 2008 financial crisis, and it picked up, that their costs were around $100 a barrel, and then they miraculously lowered their costs to $65 within a couple years. Where are their costs right now, and are the lower cost producers like EOG and Continental and Cimarex, are they actually making money, or are they basically treading water at these prices?
So EOG will say that they're making money at these prices. They are generating free cash flow, but it's pretty marginal. I mean, this is really not a good price. This is not where they want to be. Some producers are still bleeding cash at current prices. You know, some like Diamondback, you know, they're probably able to make a little bit of money at these prices, but you know, this is not ideal for them by any means. It's true that when, you know, during the financial crisis, after the financial crisis, the marginal barrel of shale was probably up $90, $100. And they have managed to cut costs a lot there. There's a number of things they've done. They've traversed the learning curve. They've squeezed out a lot of the marginal producing areas, and they've collapsed to the sweet spots. They figured out optimal usage of sand, and then because of the decline, the oil field services sector did have to give deep discounts. So that all drove prices down. You're probably at an average break even across the Permian Basin of somewhere between $50 and $60. But, you know, there are producers that are making money at a little bit less than that and some that aren't making money at $60.
What worries me, Robert, is a lot of these guys have drilled on debt. I just saw an article today about Continental Resources and how much money they're paying for interest expense. And I think it's over $300 million in 2016 for interest expense. So I guess, you know, there was a lot of capital available with either equity or debt, but a lot of these guys chose debt. And now, you know, their balance sheets are still loaded with a lot of debt and they're not making the profits that they anticipate. I guess they thought, like you said, that the oil price would be higher.
Yeah, you've got all kinds of, I saw that article as well. You've got all kinds of operators out there, some that have relied heavily on debt, some that haven't. You know, again, EOG and Diamondback, they are not heavily in debt. And I just pointed this out to somebody earlier today. They said, you know, the whole shale space is built on debt and all these guys are about to go bankrupt. And I said, don't paint with too wide of a brush here because some of these guys are financially okay. EOG will survive this. ConocoPhillips will survive it. Diamondback will survive it. And you may see some like Continental that, you know, if oil prices don't pick up, they're going to struggle. They're going to have a problem.
Is this the shale producers, are they hedged out for another couple years, or are those hedges that were at higher oil prices a couple years ago, are those starting to come off now?
When oil got to $50, a lot of them went out and did hedge. You know, some of them won't hedge. ConocoPhillips said their philosophy is not to hedge because over time they feel like, you know, those hedges cost money and they will just ride the oil prices up and down. And some did go out though and they hedged at $50. So I don't know what the level is, but you've got, you know, different companies again have different philosophies on hedging.
One thing I would like to see an improvement on for the oil industry and the mining industry for gold and silver miners has had to change this is I would like to see the industry stop reporting just, you know, cash costs or lifting costs. I think that's not including a lot of their other costs like transportation costs, cost of capital. I would like to see a more comprehensive cost list from each individual company. And, you know, we just don't really see that with a lot of the U.S. oil producers right now, a whole comprehensive list of costs. It's kind of, as you know, I was an oil analyst and you're a excellent oil analyst. You basically have to do it yourself. You have to call the company, email them to get the cost, or you have to have investment bank research because in a lot of cases the company won't release every single exact cost with themselves itemized.
Yeah, they put out a lot of misleading information. They do the same thing with reserves. You know, they go and give presentations on possible or potential reserves, and they inflate them dramatically above what you know, they have to report to the SEC for, you know, proved reserves. If you look, the presentations they're giving, the reserves they're stating are far beyond the proved reserves that they're, you know, stating to the SEC.
In your opinion, with the I completely agree with that. Yeah, there's always accounting tricks with a lot of large publicly traded companies, but that's another topic for another day, not just with the oil industry. I want to transition now to oil demand. You know, the global economy doesn't seem like it's doing that well to me, but you put out an article for oilprice.com and Forbes that U.S. gasoline demand is at an all-time high. Do you think that's because the gasoline prices in the United States are cheaper compared to other countries, that the demand for oil is for gasoline is so high here?
Yeah, so this is very much on my mind right now. I'm giving the keynote talk at an energy summit in Utah next week, and I'm putting together a presentation that basically says, you know, the demise of oil has been greatly exaggerated. One of the things, you know, the electric vehicle people think that we're on the cusp of peak oil demand. And my argument is that is absolutely not the case. And I do show, I've got some slides showing all of the record gasoline demand this summer. And the reason for that is, you know, people are driving more. Low oil prices make people drive more. The 2016 auto sales set a new record, led by SUVs. That's a headline that I've got in my presentation. So, yeah, you know, the people who think, you know, more EVs equals less oil don't realize that the equation is actually more complicated than that. There is population growth. There is low oil prices spurring demand. There's income growth, making people, you know, who don't have a car or have a small car want a bigger car. So all those things factor in. And, you know, at the end of the day, the data don't support the peak oil demand hypothesis. This is a hypothesis in search of data to support it.
Yeah, that peak oil demand, the peak demand hypothesis, Shell Oil is stating it. A lot of places have been stating it the last year, so I've heard it pretty much everywhere. But I think, like you said, with the electric cars, the expectations are really unrealistic. I think Volvo just said recently that they want to totally eliminate all internal combustion engine cars they sell in the next 10 or 15 years. I just don't know how realistic a goal that is.
Well, it's sort of, to me, it's sort of like when we mandated that the country would be running on cellulosic ethanol. You know, you can mandate certain things, and that doesn't mean that the market will materialize. So, you know, some of these guys and some of these countries that are trying to legislate out internal combustion engines, if the electric vehicles aren't there to take their place in the way that people want, they will have to change. And it's what we had to do with cellulosic ethanol. We said, you know, it's not coming. So we had to change. We had to say, all right, we have to reduce those mandates now suddenly. So, you know, we have precedent. That can change if you find that the market just is not there the way you thought it was going to be.
Exactly. I think this is, free market capitalism versus, what the central planners and the government want to do, because they want to get rid of, internal combustion engine cars. But I don't think we're at a point, Robert, where there's a lot of charging stations, rapid charging stations. There's not enough of them yet for everyone to switch to an electric car. It would overwhelm our electric grid if everyone plugged in each night. There's huge problems with our utilities that need to be upgraded. So I don't know if anyone has accounted for these things yet. And the other thing is the battery technology with these electric cars. So yes, battery technology is marginally improving, but I don't think we're at the point where people can drive, cross country on one charge, or there's not, ample amounts of rapid charging stations for large amounts of vehicle fleets in order to do, electric charging with big rigs and other trucks.
That's correct. I mean, for a lot of people, this is an inconvenience, and people keep citing to me, the iPhone came onto the market and disrupted everything, and electric cars are going to do the same thing. I said, no, the iPhone gave you something you did not have. The electric vehicle is not giving you something you do not have. You have more mobility. You can go more places with an internal combustion engine. So electric vehicle is giving you some, feel-good factors. It's the performance of a Tesla is excellent, but it is not giving you things that you don't have right now, which the smartphones did. They gave you the ability to do things that you couldn't do before.
I also don't see, I live in a pretty progressive area right outside of Washington, D.C., and there's occasionally one or two charging stations inside of an apartment complex, but there's no, massive amounts of electric charging areas. So this would be a problem. The infrastructure is just not there. So I know, Elon Musk is talking about how quickly he's going to build all these charging stations, but he hasn't delivered on a lot of his promises with Tesla in terms of how many cars he's going to make, and there's a lot of problems with Tesla Motors as well. So I just don't see the infrastructure there for this thing to happen in as fast a timeline as the electric car makers want, as the politicians and the other people, environmentalists, want to see this done.
I totally agree. I mean, and Tesla's a funny case because investors don't care. Tesla just reported the biggest loss in its history, and the share price surged based on what Elon Musk said, not what they actually delivered, but what he said. And that seems to be the case quarter after quarter, is they fall short and then they make up excuses and they say, everything's great, and the share price surges. So I think there's a real disconnect there in the fundamental value of Tesla and what it actually trades for.
I completely agree. I actually interviewed hedge fund manager Mark Spiegel, and he actually wrote a comprehensive report with like 200 different citations showing all the different competition that's going to become. Basically, every single major car company in the next 5 to 8 years from pretty much every major country is going to be coming out with hybrids or electric vehicles in all of the different car classes. And that means then that, Tesla's profit margins on some of their luxury cars, those things are going to get eaten away. So they're not going to be able to maintain any of the margins that they have now either.
Right. And I've made that point, too, that Tesla investors are acting like there will be no competition at all and that Tesla can just keep growing and growing like crazy. And that's not going to be the case. But irrational investors can wipe you out. So I think Tesla at some point is going to go down a lot. But until it does, it'd be foolish to short them because irrational investors keep pushing the share price higher.
Exactly. It's the value investors, the people look at balance sheets and the financials are the ones who are shorting it, like the David Einhorns of the world. Those
Yes.
are the ones. But yeah, the rational people, like you said, the growth and momentum people who it's kind of a cult of Tesla, because anytime Elon Musk said something, Elon Musk was talking about, investing in an internet radio company, having Tesla buy that and then digging tunnels under LA. I don't know how that works with his company, but the stock moves when he says random stuff like that.
Yeah.
I want to ask you about your opinion for the long-term ramifications of hundreds of billions of dollars in CAPEX cuts, as we've seen in the last 4 or 5 years for the oil industry. It seems, Shale's gotten a lot, tens of billions of dollars in CAPEX spending, probably more capital than they should have gotten. But the rest of the industry, has been starving for capital, been cutting back like crazy, including national oil companies. In your opinion, what's the long-term ramifications of all this?
So there are a lot of predictions that this is going to start to bite maybe in 2020 or 2022, that we are going to start to see a shortfall. If you think back a dozen years, what happened with the whole peak oil scare, we had oil prices that were too low for a number of years, and that caused underinvestment. And that underinvestment, once oil prices started to go up, there was really not much response at all. OPEC didn't respond, U.S. producers didn't respond, and so it led to this hysteria that, yes, peak oil is here, and it led to oil prices running up above $140. And eventually, investments were made, and the shale boom happened, but there's quite a lag on that. And so now we're starting to see that again. We're starting to see investment get cut. At $50, there's not nearly as much investment as there was when the expectation was higher. And so I think we will see that. I think the reason that oil prices hung in at $100 for so long is because there was just this fear, and had been the fear that we're at the end of the oil age. And once it became readily apparent that there was more oil out there was a lot of shale oil out there, and that OPEC did have extra production, that has pushed the prices down. And now we've got this expectation that is being widely promoted in the media that we're at the end of the oil age now. Who wants to invest in oil if oil's on the way out? And I think we're going to take an actual shortage. We're going to have to see another situation like we did 2005 to 2007, where underinvestment leads to a shortage of production relative to demand growth. And we're going to see oil prices rise again, and people are going to realize, hey, oil has got a few years left.
The CAPEX cut seems to have hurt the deep water and ultra deep water the most. Seadrill's basically bankrupt now. Their shares haven't gone to zero yet, but I think they're below $1 again.
Yep.
And Transocean has basically had to turn around the company. I think they may be looking to do some acquisitions of some deep water rigs, but that seems to be where the majority of the drilling and production cuts have come from, is spending that CAPEX to try to find those large, giant, 50,000 barrel per day wells underneath the ocean.
Yeah, I mean, you don't want to go out and spend that kind of money if there is still plenty of shale to be produced. I mean, that ultra deep water is very high cost production, and when oil's $50 a barrel, you don't want to be out there investing in ultra high cost production unless your expectation is that oil prices are going to zoom, and the futures markets are saying no, and so you can't go in and you can't hedge, you can't expect that oil will get back to $80 or $100 a barrel, so you're going to not invest in those high marginal production areas.
So basically then you think in order for that part of the oil industry, the deep water, to start getting a lot of capital again, basically there has to be huge production declines proven over a long period of time then from the Permian, the Bakken, the Eagle Ford, or are there going to be a lot of capital spent then on a lot of other shale plays all over the globe before the capital starts to flow back into deep water?
Well, that's a good question, and I get that question a lot. Is the shale revolution in the U.S., is that going to play out in other countries? And I think, like for natural gas, I think it's going to play out in Argentina and maybe to an extent in Australia. But I don't know about oil. I don't know that the U.S. has got kind of unique geology there that really lend itself well to fracking and horizontal drilling. And a lot of places they haven't had that kind of success. They tried it in Poland, they haven't had much success. China, the problem there is the places where they've got the resource, they don't have any water, and you need water to do this. So it's hard to say. I don't think any place outside the U.S., maybe Russia, but Russia's still got plenty of conventional production, so they really had no need to go and drill in their shale much. But if that happens, if there is a lot of sort of U.S. type production capability around the world, we're going to see oil prices at $50, $60 for a very long time.
Yeah, I think there's a lot of supply overhang that could come online at $50 or $60. I think we either have to have a lot of a couple national oil companies, maybe Venezuela, all their production comes offline, with the sanctions that Trump and Mnuchin just put on Venezuela today, how no one is allowed to finance any of their government debt or any of their national oil company debt. That could potentially accelerate a collapse of Venezuelan oil production in near future. We'd have to have that type of event maybe where production came offline in order to move oil prices back up, because I don't really see a strengthening global economy to move oil prices to $80, $100 a barrel.
Yeah, I agree. And Venezuela's a train wreck right now, and they're, even though on paper they have the highest oil reserves in the world, their production has been declining for years, and it's because it's challenging heavy oil to produce, and they've basically kicked out most of the Western expertise that were down there, producing that oil. And if things continue to deteriorate down there, you could see their oil production, drop to nothing. They still supply a lot of oil to the U.S., so our oil prices would rise here, and that would be good for our shale oil producers, but not necessarily good for the global economy.
Yeah, and Venezuela also, their government has siphoned off the oil profits. So if that was a private sector business, Robert, you would see the profits reinvested into improving new equipment for oil refining capacity or increasing oil capacity at scale to lower costs, or figuring out a way to improve the spreads at the refinery margins or things like that. And that's not what's been happening really for the last 10 years in Venezuela with respect to their oil industry.
Right.
I want to transition now and ask you about peak oil. We've discussed this in the past. Peak oil doesn't mean that we're running out of oil. It just means that we're out of the cheap stuff. Do you think that basically then, despite all this capital spending in the shale boom, then that we are still running out of cheap oil?
It depends on what you mean by cheap oil. So if we say, has $20 oil peaked? I would say absolutely. The oil at $20 has peaked. But I think the part that peak oil proponents really missed is that there is a lot of production that can come online at $60 or $80 or $100. So I think it was really missed that peak oil is very much a function of oil prices, and as oil prices go higher, there will be more production come online. So it's sort of a moving target. Where does oil peak? Well, tell me the price, and I'll tell you where it peaks. If you tell me the long-term oil price is $20, I would say yes, oil production has peaked and will never go higher. But you can see that maybe at $50, $60, oil production has turned back up in the U.S., albeit with an expectation, I think, that it was going to $60. But I think at $60, you will still see oil production continue to grow. At $80, it'll grow more. At $40, not so much.
There's been a lot of technological innovations. You have horizontal drilling. Fracking has been around for a long time. The technique has obviously improved. You have these octopus drilling pads. So you've had a lot of improvements in deep water drilling as well. So these things have, let's say, delayed any of the peak oilers' predictions, knocked it down, because I don't know if they really expected the technological advancements to bring this much supply to market. But what worries me, Robert, is that you have a lot of cases where a lot of potentially uneconomic oil production has been funded basically with people on Wall Street or pension money, where really bad energy return on energy invested projects got a lot of capital. So
Yeah, that's true. But I want to make a comment on the technological innovations, because a lot of people don't know that King Hubbert, who is credited with predicting the 1970 peak in U.S. oil production, he actually predicted that it was most likely that oil production would peak in 1965. And he said it could be delayed until 1970, but I doubt that, because that would require finding 8 new giant Texas oil fields. He said that's the requirement, so he's skeptical. But it turns out they did find those 8 giant Texas oil fields, and they found them in existing oil fields. They found them, they were able to squeeze more, they were able to increase the recovery from those oil fields. So technological improvement did delay that peak that he predicted, and it peaked at a higher level than he predicted. And the world as a whole is producing far more. He predicted peak oil for the world at 30 million barrels a day or something like that. So, he was way, way short because he underestimated technology.
That's a good point. Yeah, and, conventional oil production, a lot of that, the oil where you just drill straight down and then it's like Beverly Hillbillies where you hit a gusher, light sweet oil, that crude is a lot tougher to find. But I mean, with the technology, they've been able to do oil sands, they've been able to do deep water, they've been able to do shale oil. So, the unconventional stuff has replaced a lot of the conventional oil production.
Right. And fracking and horizontal drilling is not so unconventional anymore. Some people act like this is really high cost oil production, and it's not so much anymore. Horizontal drilling's been around a long time. Fracking has been around a long time. It's just the combination of the two that hasn't been around all that long. But this is not really high energy input oil, and a lot of people confuse this with maybe bitumen or oil sands. I see people doing this all the time. It's not like that. It's very close to conventional oil production. It's just it's a derivative of conventional oil production, but it's not that unconventional.
I see. Yeah, and it's also I think the oil is not heavy sour crude like the Venezuelan crude, which requires a lot more refining expertise.
Well, that's the other point. A lot of people think that shale oil is oil shale. And I run into this problem all the time where people, in fact, a guy asked me a question this morning. He said, is it true that refineries can't process very much shale oil without having to cut it with light sweet crude? And I said, shale oil is light sweet crude. I mean, that's what people don't understand. It's fracturing these shale formations and these tight oil formations to allow the oil to flow out. But the oil itself is not heavy oil.
Yeah, and the oil refineries didn't anticipate the shale boom, so they had actually switched a lot of their refining capacity in 2008 and 9 over to heavy sour because they were anticipating having to import more Saudi. They're more marginal crude, not as good, and also Venezuelan. And now they've had to change the type of crude that they can refine because of the shale boom.
Well, and a lot of them aren't changing it. I mean, we're starting to export more and more oil because if you've invested in the equipment to process heavy sour oil, your margins are much better on that oil, and you would rather continue to receive it. So, Gulf Coast refiners, they would rather take Venezuelan crude, and then, the U.S. producers end up exporting that crude because it's just not a good match. It can go in the refineries, but you've got a lot of capital equipment that is not, doing you any good. And, the yields on that heavy sour stuff are just as good, provided you've made the investments necessary. So they'd much rather get that deeply discounted heavy sour stuff and process it.
That's interesting. Now, with the remaining parts of the interview, given how oil maybe because there's the potential for even more supply to come online, who would benefit from this? Would it be the oil refiners then? Because the refiners have a predictable oil price that's going to stay relatively low, so they're going to have more predictable margins. Do you think there's good investments to be made with oil in a trading range like this?
Yeah, refiners are exactly it. I mean, they're the refiners as a group have outperformed the broader markets even during the energy crash. And that's because as oil prices go down and as they're soft, they can usually maintain margins. It's when oil prices are rising that you want to be out of the refiners because their margins usually erode. But, if I thought oil prices were going to stay right where they're at, then I think in the energy sector, the refiners is where I'd put my money. And then after that, maybe the large integrateds who, have they've got refining capacity, they've got midstream, they've got some upstream, and some of them can make money at $50. But I think the best bet is a pure refiner.
That's very interesting. I want to ask you before I let you go then about the natural gas market. We have Cheniere Energy starting to bring online natural gas exports. There's other large LNG export facilities being built in the United States, and I think one in Canada. Do you think then this is going to hurt the natural gas price going forward?
Well, I mean, in theory, you should be seeing natural gas prices going up, but demand, because demand is surging. I mean, we're exporting a lot to Mexico now. I think we've got 4 or 5% of our supply going to Mexico, and another like 3% is going to Cheniere's facility. That is now the largest single recipient of natural gas in the United States. This is Cheniere's facility. The problem is that production has kept pace, and if production stumbles at all or flattens, and the other thing is we've had very mild weather, so that's moderated demand. Over the winter, we had a pretty mild winter, and so demand wasn't where, it was expected to be. And all of these factors have moderated natural gas prices. Should there be a stumble at all, or should, natural gas inventories are now right in the middle of the 5-year average band for the season. A year ago, they were at the very, very top. So we were very flush with inventories a year ago. We're right at about average now. We're heading into withdrawal season. Average, maybe, if we come in below average and then we have a very cold winter, you could see, always weather is the short-term factor that influences natural gas prices the most. And whether we have a cold winter or a mild winter, that will determine where we're at on natural gas prices in a few months.
And the large integrated oil and gas companies like Chevron, Exxon Mobil, Shell, Royal Dutch Shell, they seem to have bet more on natural gas long term than on oil. And some of these larger companies like Exxon Mobil, they've used tens of billions of dollars with artificially cheap debt, in my opinion, to buy back their shares at higher prices. What they should have done, Robert, in my opinion, instead of buying back shares with debt, they should have focused on acquisitions and locking up oil reserves, going out and buying some of the larger mid-tier independents like Apache and others to keep their oil production high and grow reserves that way. And that would have been smarter in the past than buying back their shares with debt at higher prices and increasing their dividend.
Yeah, I think if I was Exxon Mobil, I would try to figure out how I could acquire BP, because BP's reserves on the books are a fraction of the cost of Exxon Mobil's. And so instead of running around the world looking for oil, you can find it right there on BP's balance sheets at something like $9 a barrel, where Exxon Mobil's are on their books for more than $20 a barrel. But the problem is BP is a very big bite to swallow. There aren't many companies that could do it. Shell looked at them before they went out and bought BG. I think there'd be some antitrust issues, and I know the UK government is going to put up a fuss, but BP is very, very low cost relative to the reserves that they hold, and I'm certain that companies like ExxonMobil are looking at them, but maybe they've decided now is not the time to strike, or it's too big of a bite to swallow, because ExxonMobil has taken some big bites over the years, and they may not be in a position yet to do that. But I guarantee you they're aware and they're looking at it.
Yeah, and ExxonMobil also just had their credit downgraded recently from a perfect AAA downgraded slightly. So, I mean, the market is, they do have a nice dividend, and they probably won't cut the dividend or anything like that. But, the last 10, 15 years, I think the company hasn't been managed quite as well as they probably should have in terms of thinking long-term about, maintaining oil reserves and growing production, that they tend to focus more on keeping the share price. I call it financial engineering. So, making sure the share price stays high with share buybacks with debt, and either maintaining the dividend when they probably shouldn't have, or increasing the dividend.
Yes.
Well, Robert, I always enjoy our discussions about the oil and gas market. You're just a wealth of knowledge. If our listeners want to follow more of your work, either your free articles or subscribe to your newsletters, how do they do so?
Yeah, so you can find me. I have a weekly column at Forbes, and you can find me there commenting on the overall energy sector. And then I write several columns for Investing Daily. I write two free energy letters a week, and then I have a subscription column there called The Energy Strategist, where I provide specific instructions on investing in oil and gas companies, buy, sell instructions, and then we have a model portfolio that we manage for investors.
Excellent. Well, thank you again for your time, and I enjoy talking to you. So hopefully I'll get to speak to you again in the next couple of months.
Sounds good. Until next time.
Wall Street for Main Street needs your help. YouTube stole $7,200 from Wall Street for Main Street in annualized YouTube AdWords revenues, and they kneecapped our analytics down by more than 80% across the board since September 2016 with their new censorship algorithms to stop the rapid growth of our channel. That was money we could have used to upgrade our website, pay bills, and invest in improving our content and growing our business. Our audience of loyal listeners is all over the globe and so large now that if most or all of our listeners were to commit to donating $1 to $5 each month to our Patreon account, we could easily meet our goal on Patreon. Wall Street for Main Street also accepts one-time donations on our main wallstreetformainstreet.com website. That's WALLSTFORMAINST.com website via PayPal, Gold Money, or Bitcoin. We also accept donations of physical precious metals that can be mailed to us. Thanks to all listeners who have already made a donation, and thanks in advance to any listeners who make a future donation or contribution to the growth, improvement, and success of Wall Street for Main Street.